Hello and welcome to M&A Access, the official podcast of the Alliance of M&A Advisors. This is Ekaterina Kozlova, and today we're talking about what it really takes to close the deal the second time around. Eric Heath brings together a panel of seasoned investment bankers, private equity partners, and strategic buyers to share lessons learned from bringing deals back to market after they fall apart. Let's turn it over to Eric and get started.
Hello and welcome. Thank you, everyone. The panel is Second Time's the Charm, How to Close the Deal After a Failed Exit. We'll be talking about the strategies involved with taking a deal back to market. What does that look like? What are the challenges? What have we seen personally and professionally? And maybe how to strategize if you find yourself in that position. My name's Eric Heath. I'm the Managing Director for Blue Jay Advisors. We're a transportation and logistics sector-focused investment bank, predominantly in the lower middle market. I have my pleasure here of four great panelists. I'm going to let them each introduce themselves.
Jim D'Alessio, spent 40 years in the transportation business on the operating side. Literally had every job from driving a truck to the CEO suite. And then I retired 7 years ago, founded Pivoting Strategies, and I came over to the dark side, and I consult for private equity now. I'm on 3 transportation boards, and I'm an operating partner for a boutique private equity out of Houston. But I am retired.
Doesn't sound like it. I'm Michael Norton. I'm the Director of Business Development for Houlihan Capital. We're a Chicago-based valuation firm and investment bank. Our iBank focuses similarly on lower middle market transactions, and while our valuation arm is full service. Hopefully I share some good insights here.
Hey, I'm Brian Pizer, partner with High Street Capital. We're a lower middle market private equity buyout growth equity firm. We focus on opportunities where we can add value with our operations team from the inside out to grow and scale organizations across any kind of business to business, industrial, business services, distribution, logistics type business.
Brian Steffens. I'm a managing director at Caber Hill Investment Bank, lower middle market investment bank, buy side, sell side advisory, business services, industrials, manufacturing, and healthcare services, firmly in that 2 to 10 million of EBITDA range.
Perfect. Thank you, gentlemen. So, first question for the panel, and Brian, I'm going to pick on you. I'm going to let you start. Yeah, I knew. What are the most common reasons deals fell apart for the first time? And a couple of potential examples: valuation gaps, diligence surprises, structural issues. And in your experience, which of these is the toughest to navigate? And then after you, happy to hear from the rest of the panel.
You said you weren't going to pick on anybody. So I'd say, as I've been doing this a long time now, I sort of just assume it's going to break down 2-3 times and sort of assume that the ideal buyer is not going to be who comes to market for various reasons. Maybe they're busy doing something else or, currently integrating. And so I just kind of start with the cynicism to begin with. So expectations are set pretty low. But I'd say, I think as far as I'm concerned, I always try to do a really good job with presetting value expectations, structure, et cetera. I feel like that's me as as our firm or, as a banker, like trying to do that and proving out with facts as best you can. Obviously, you get into the heat of battle, it might change, but at least you can feel good that you've set those expectations to begin with. So for me, the big challenges are always, a dynamic business. So it's changes in the business profile, it's losing customers, it's tariffs, things that outside of your control. So you can kind of control what you can, outside of that you can't. To me, those are the toughest things, and what I always try to do is just make sure that, the communication is transparent and crisp, so if there are things that are starting to show up, we can obviously communicate with our client, but maybe those buyers that are more advanced, you can let them kind of know what's going on, keeping them plugged in. Going dark is the last thing you want to do, and that's where I've had at least the most success of keeping things on the rails, or having built the credibility and the trust to, again, we're talking about bringing it back. If you've got to bring it back at some point in time, you've laid the groundwork to do so in a way where you've got a starting point again.
Yeah, I think piggybacking on that, my dad was one of the managing partners at a fund for many years, and when I took this job, when I had my first deal die, he just reminded me and said, hey, our saying in our firm is every deal dies 3 times, and so I was freaking out because it was a big paycheck that I thought I wasn't getting, and it turned out it was much ado about nothing. But I think my experience and our experience at Houlihan. Time, greed, underrepresentation, whether it be accounting, legal, you name it, and then the macro unknowns are the 4 things I think that kill deals the most. We try to get beyond greed, like Brian mentioned, at the outset. I'd say we're almost honest to a fault when we're pitching a deal. Most companies will trade for an X to Y, as everyone on this industry kind of knows, and we just have to be very honest with our prospective client that our goal is to get you Y or higher always. We're always trying to drive the valuation, maximize it upon exit, but we really want to be rowing the boat in the right direction, same direction when it comes to valuation, because that's something we can at least be honest about. Time, we just be as structured as possible, but as people know within this due diligence environment, some of it we cannot control, but we control what we can. And underrepresentation, our clients don't always take our advice, but we will tell them if their legal, accounting, et cetera, counsel is not the right team to bring them across the finish line. They don't always trust us, so we do apologize when we bring something to market and you guys are seeing it and you're like, well, this guy has a fax machine still, but it happened to us. We try to take advantage of those as much as we can. Macro stuff, obviously, we're a 40-person employee-owned firm. We can't have any role in impacting that.
Yeah, I mean, for sure, I think the biggest thing that kills deals or puts things on hold is financial performance. And so the company needs to perform to the expectations. And the question is, who sets up those expectations? And are they properly established by the people actually running the business? I think a lot of times the management team needs to be aligned with the advisors as to what the business is expected to produce, and management needs to be confident in those expectations. On the flip side, I think preparation is really important. And you mentioned time kills deals. It's an adage we've gone by for a long time. But the reason why time kills deals is because of preparation and the lack of availability of information that the diligence is going to require from the buy side. And so setting up the expectations as to what is going to be required for the buyer to get through a diligence process is very important so that you're prepared and you've got the information ready and available. And not just one time, because in these days, diligence is taking longer and longer. You're going to need to roll that forward. And so can we get an update of the chart? Can we get an update of the information? It needs to come fairly quickly. If it takes too long for data to get through, the buyer gets nervous, people get uncomfortable, and that's where things go the wrong direction.
And I'll just add, as a strategic buyer that bought 20-something companies, I'll add culture. If you're a strategic buyer, all the other stuff could all just line up perfectly, but if the culture doesn't marry in to the acquiring company, it's not going to work. And I've seen acquisitions where it just goes dead even after you buy the company because of the culture issues. That, and also if you're a financial buyer, I sometimes worry that the management team is not the team that's going to, that if you're buying, that's going to get them to the next level. So those are 2 things that cause them to fail.
Sure. It's all really great. So I guess as we're talking about these reasons, how do you assess whether a failed deal is worth salvaging or if it's just better to walk away altogether?
Well, I think it depends on what the buyer engagement looks like. Are they leaning in? Are they asking the right questions? You can probably tell through body language whether someone is trying to find a way to get a deal done or trying to find a way to kill it. And are they spending time and money and resources? Are they engaged with the management team? Do they take that extra visit? Are they talking about their plans for the business? Or do they just keep shooting darts and coming up with reasons why not to do something? So I think it's challenging, but if you're going to stick with that same buyer, I think you need to understand their motivations for getting a deal done. If it's strategic, they really want it, it fits well, that probably is a good avenue for it to continue. If it's financial, you really got to see that they're leaning in. And really, they're trying to get it done. You can go, talk about their investment committee. What are your reasons for doing the deal? What are you guys talking about? If they're trying to, a lot of times they're trying to work with the team to come up with a position and solution to present internally to get it done, then that's a very positive step. If they're just looking to poke holes, then that can be difficult.
Yeah, and I'd say on the sell side, I think it kind of depends on what you're talking about. If it's salvaging the deal with the buyer that you have, I completely agree with everything Brian said. If that deal is done, if it went through those couple, 2-3 times of dying, a lot of times when we're talking about whether it's worth it keeping our client relationship going forward, it could be what was the reason for why it failed. And we one of our recent ones that did, it came to light really during the process that the seller wasn't really willing to take the steps it needed to do to resolve certain things that needed to be done to sell. This one, there was a particularly large inventory issue. It was essentially they had no idea how much they had, and it was like we've been telling you for months and months and months we need to take care of this, and you're like, oh, we get the buyer, and it died, right? So we would love it if that deal did come back because it was actually a nice company, but we really, really need them to agree to take our advice and the advice of all the other trusted advisors that they had in the room. Because at the outset, it seemed like a phenomenal deal, and it really didn't come to light until well into the transaction that there were these glaring issues, and that came back to bite them.
Yeah, on the due diligence process, there's always things that are uncovered. And you can tell pretty quick if the seller is really motivated to sell. Are they fixing those issues? Because when you bring it back to market, and the first thing the buyer is going to be looking for is these are the issues that we had and what's been the resolution. And oftentimes, unfortunately, family-owned sellers, they just emotionally can't let go. And that's when you got to know to walk away too.
I mean, not much to add other than I'm generally a glutton for punishment, so it's really difficult for me to walk away. But I'd say the only thing I'd add to what they said is just, starting with, do you agree on the set of facts as to what happened to begin with? As long as I can get comfortable that we're in agreement, like in this case with the inventory issue, they're well aware of it. We've already talked about it. If it hasn't changed, why would we go back to market? Again, variables that could change. Well, maybe my value expectations, maybe my structure. Is that going to change my level of confidence of success? And maybe there's an answer that's yes. I've got one right now that has been a couple years. We've gone out a few times, and he's just ready. He's 66. He realizes he's ready to go. There's a lot that hasn't changed in the business, but his value expectations have changed drastically, as has his structure. So, and he's being pretty honest about it, and I've started to pressure test that with a few trusted parties that I know that were part of the process before, that can quickly get asked the 6 questions, and I can send them the roll forward and see, and just say, where are you at? And if they can you just, put that in there and see if he's really truthful. But that's because I have that relationship with them to do that. So that would be one of those reasons why I would still do it, as long as making sure that you understand what the facts are first and then what's changed.
Mm-hmm. Yeah, absolutely. So first of all, I really appreciate all those answers. It sounds like in order for these deals to get done, you need trusted advisors on both sides, right? Like you have to have, in the best deal, someone to help the founder-owned businesses walk through their valuation expectations, some of the things that they have to work on in the business, and then also on from the buyer side, someone speaking to the diligence items as they come up and say, are they going to get addressed? Are they not? Do we have our expectations set in the market or not? Right. And so I appreciate that. I think it'd be really helpful to hear if you have a real world example of a deal that failed initially, but then on a second or subsequent, whenever third or fourth try, whenever that you were able to succeed, and maybe what what were some of the aspects of that made you successful?
Well, I'll start. This is probably the wrong example. I've had multiple acquisitions that we did that failed the first time, succeeded maybe the second or third time. But I have one that just stands out because it was really terrible how it played out. Good for us as a company that bought it, but at the end of the day, not for the sellers because they got greedy. We were looking at an acquisition. This is back in 2007 in a trucking company in South Carolina, actually, that fit a gap that our company was looking for. So we sought them out and courted them for the better part of a year, made them an offer that we thought was more than reasonable. While we were doing that, they had engaged another company to market them, and they turned our offer down, pursued them still. The company that they engaged could not sell them. A year and a half later, which is now 2009, we bought that company out of bankruptcy on 20 cents on a dollar. And good for us, not good for the seller.
It does happen. I mentioned the one that is live right now, and that we're just treading water on that. But another one that we had was really pulled by the seller. We had gone out, we'd gotten several solid offers, and they decided they wanted to take a different route, go the ESOP route, and we explained to them all the reasons why that wasn't the best route, and we are an ESOP now, and we've never been anti-ESOP, but it just didn't make sense for the business itself. But they still wanted to pursue it, and after many months, long time, they figured out that we were right. They came back and pulled the mea culpa, but also said, can we do this? We really want to sell. Can we run a limited process? And that was great for us because we already had many groups that had expressed interest the first go around, and the business to the point of that was made earlier was still performing. So they'd maintained their end of the bargain from a business operations standpoint. We really liked the business, and to their credit, not only did they sell, they sold to a group that then shortly thereafter sold their platform. So our client got a second bite of the apple really fast. So they actually did very, very well as a result. And, we thought they were gone. When they walked, we just thought the deal was over. And, that was, okay, did we have were we aligned with them at the outset, or were they using us to figure something out so that they can then parlay that into a good valuation for an ESOP? Just was, they actually want to do right by their employees. It was nothing to do with, anything that we were, misaligned on.
I think from an opportunity that we once worked on that we tried to buy a company, they stepped away, and then ultimately came back, and we ended up doing that deal. And part of that was because of buyer expectations, both of the market and how they could execute their strategy, but also our expectations of the performance of the business that were, quite frankly, not as strong as the current owner, and they thought they could outperform, the opportunity. And so a couple things happened. They stepped away and tried to execute a lot of the strategy on their own, and realized that they actually needed some more capital to do what they needed to do with the business. So in a way, they kind of came to market maybe a little bit too early, with not having a full understanding that this was the path they wanted to go. They kind of were in between on the first go around, so they just weren't quite sure. And then on the second piece, the business was performing really well, and they proved it to us over the course of a year or two, and we ended up having to use some structure and earn out solution in order to get everybody comfortable that the valuation was proper. But in that case, it was really just a buyer getting cold feet and then realizing, no, this is actually what we should do, and so they came back.
So last year, I had one of my clients ended up buying two businesses that I was on the buy side. Two businesses that were one I had 4 times tried to buy with other clients. The other was 3. And so in each case, we made, offers on them, and, various reasons, value expectations, wasn't ready time-wise. But, I think what we always did was we continued, even though, because they were nice people, nice firm, nice companies, continued to perform. They had interest. I understood their reasons why it wasn't the right time or it wasn't the right fit. Likewise, I didn't begrudge my clients for not moving forward. I understood their strategic reasons why and where they were at structure. But we maintained those relationships, continued to give them feedback, guidance, advice, if you will, on, hey, if you really want that valuation or that structure, these are the things I would work on if I were you, and just kind of treating them like you would someone that you would like to stay connected with. And, my client last year happened to be the beneficiary of when we picked them up. We knew exactly, in our kickoff meeting, we had, a dozen companies that I could text in advance and let them know I'm working with somebody. I already had positioned them as potential sellers when they told me they were interested, and strategically could share what we knew about them and the time frame with which we saw them perform in their growth and what they had done in the business and why they should like them and how it fits with their strategy. So, we were able to do that, but it was more to do with, I guess, staying open-minded. In some cases, I always kind of say it's the, every day you kind of got to wake up and remember everything but forget everything that happened yesterday. So, like, forget all the emotional things or the people that let you down, but still and do, reset what you need to get done that day. And that's, I think we've done a good job of that through the years with these types of scenarios, because most of the deals inevitably are broken deals in some way that just now everything kind of aligns.
Yeah, absolutely. Well, and I'll share a quick story on my end. And unfortunately, I'm not the hero of this story. The buyer is. But I had a deal where independent sponsor, I had a tough client, really tough client. And he only wanted to talk to one buyer. And he found an independent sponsor and that he loved. And that independent sponsor created just incredible relational equity with that seller. And it took over 18 months to close the deal because he kept losing his financing. It lost it, I think, 3 different times. Once because President Biden said something about eliminating the independent contractor model, so it blew up the deal. Another time for another reason. And then, so what was amazing to me, though, that buyer in this case, I think, Brian, you said it, like, was trying to find a way to get the deal done and was communicating and transparent, and to the point where my client would literally not let me take them out to anyone else and stuck in there for 18 months, which was just an incredibly long time. So again, I'm not the hero of that story. I was just the sales advisor that was there. I really think that the reason why that deal got done the way it did was because the buyer stuck it out, made it happen, and had to go through, 3 different failed capital rounds to make it happen. And now, on the other side, are doing really well with it. So, maybe as a follow-up, so what do you think is the most effective way? So if we're thinking about repositioning the narrative for a company as it goes in the market, what do you think is the best way that, if maybe thinking about from the sell side, to rebuild that buyer trust and to better align with what the buyers are looking for?
I'll start. So you have to remember now your SIM has been is still in the marketplace from the original one. So the best thing you could do is build a storyboard that talks to the inequities of the first failed sell and what you did to fix those. If you can present a storyboard that this was an issue, this is what I did to correct it, this is what I did to correct that, you go a long way in getting the confidence on the buyer's side that, yes, this company has repositioned itself. I've seen that happen probably the best.
I think it's, one, it's, regardless of whether it's the first time out the market, second, third, we always stand by, we're explaining the past, we're selling the future, of the business, right? And so, the first time around we did that. Now we've got to explain the past 12 months, past 18 months, whatever that time horizon may have been. And I agree. I think you have to be honest. There you can't. If you go out and you try to hide the 8 ball especially with a buyer that had gone down the path for a while, then you're just being disingenuous, and that kind of ruins your reputation as a sell-side advisor. The buyers aren't going to trust you. But B, you're sugarcoating something that could have been bad, or could have simply been, here's what happened. We explain A, B, and C occurred. Here's why the deal went awry, or here's why our client walked away. We were already kind of, we have one deal right now. We're already kind of trying to figure out what that narrative's going to be, because our client was, this was tush push, 1 yard line, no one stopping this, going in the end zone deal. And our client just got cold feet, and he walked away from tens and tens of millions of dollars. And it was 74, I think, at the time. No kids in the business, you name it. He mentally wasn't there, and his business is still doing well. We're still retained. There's a chance it will see the light of day before the end of this year. I doubt it. It'll probably be sometime next year, hopefully. But we're already talking internally. Okay, how do you frame that with okay, this now he is ready to sell. I think that's there, especially for the group that was under letter and was they really wanted to buy the company. And when they were paying, it was a very fair multiple. I think with that particular buyer, it's like, okay, we're gonna have to have a dinner, and clear the air dinner with our seller, with their CEO, just to have make sure that they still love each other, right? And that's that one will be a fun dinner to be at, to watch, but I think it's just going to be, okay, this is why we really are ready to sell now. And then, obviously we'd like to make it a competitive process. So like maybe there were groups that saw it the first time around that, didn't compete, or maybe there are groups that didn't see it the first time around, or, didn't submit the first time around. And now we've got to explain why it's even a better company now, given the market, given yada, yada, yada. So that it's more just developing that trust and making sure that the individual, the business is phenomenal. The individual he's a great person. He wasn't mentally prepared. So that's going to be the main sell, because the business itself, truly, I believe, will sell itself. It's a phenomenal business.
I think one thing you mentioned was important there, which is the company could be a better business now than it was 12 months ago, because it went through those issues for a number of reasons. One is, we see so many businesses, represented by these amazing advisors here on the panel.
Amazing.
Where everything looks great, and it's going up and to the right, and the margins are expanding, and everything's. And then we look at it and say, well, are we buying this at the peak? What could possibly go wrong? This concentration, whatever. But, something's going to happen in this business. I've been doing this 22 years. No business goes up and to the right forever, in a straight line. So if you have an issue, and potentially that's washed out, and maybe, at the end of the day, maybe your largest customer cut back, or you lost, or whatever it was, and now that risk is gone, right? And also, you've seen how the business reacts when something like that happens, and how the business can rebound. So the buyer, in a way, is able to see the bumps in the road play out real time, and see how the business can react and respond, which gives you more confidence that you'll be able to respond if something happens in the future, because something's going to happen, and you had the advantage of seeing it happen. So I think, as you say, going through, explaining what happened, what the business did to respond, building that confidence and trust, and then you do need to regain momentum. The business needs to then start growing out of that situation. It can't continue to decline. That's going to stop every process. But if you start kind of lifting the wings a little bit and starting to rise, then I think you've built a lot of confidence.
Not much to add.
No, totally understood. So what I'm hearing is storyboarding, right? Making sure that there's a clear narrative of what happened, what we did to fix it, and addressing the fact that there's likely books in the market that people have seen Sims, and maybe more people than right? Have seen Sims. Way more people. I like, Mike, I really like that idea of getting people together, by the way, of creating that. And Brian, of clearing the air, right, of what that looks like. And then, Brian, it's an interesting point you make about saying what you expect something as a buyer to happen. So the fact that it happened maybe isn't the worst thing in the world, right? As long as it can be explained away that we've touched bottom and we're not. This is not maybe a falling knife situation as we talked about before. So maybe that kind of just asking this question just because there is a stigma around companies that came out like I've seen this before. Oh, so and so had it before it was Houlihan Lokey, not Houlihan Capital, had it out last time.
Well, then we would absolutely be the better shop to use. I'll be here all week.
I'm gonna get myself in trouble. So just even if you want to kind of address this on either side, whether from a buyer seat of how do you look at a deal that has been, if you didn't look at it before, but it's been marketed, it's been in the market before, how do you approach that? And then again, maybe from the sell side, how do you get ahead of the stigma? Just whether something's been fixed or not, but just knowing that there's just a general stigma that exists.
I mean, I guess it depends on why the business, if it's performance issue, that's one thing. There's plenty of buyers that step away for lots of reasons. We had one, in the market we were selling, and the buyer stepped away because of their own performance. It was a strategic-backed private equity company, and they weren't performing, and therefore they weren't able to allocate capital to an acquisition. It had nothing to do with us. We were an amazing business, but yeah. So there's plenty of reasons why things don't work out, and I don't think there's a ton of that stigma. In some ways, something that didn't work and comes out again, I think people see opportunity in that. Sometimes you don't want to be the first one in there, and then some of the expectations from the owner have been better explained, and they're just more ready. And so I think there's in some ways opportunity for that, but I don't put a lot of stock in the stigma side of it.
Yeah, I'd say, like, my feeling around that is always, do I believe the story? Because if you're being brought in there, you're understanding, again, were they upfront with me that it was out on the market? Maybe I knew, I didn't know. But what are they sharing with me about that process? Starting with an open-ended question like, how'd that process go for you? What'd you like? What didn't you like? How, what did they do? What were the questions you had? What were the the buyers that they went to? What was their feedback? I think you're gonna, and I always do it like just trying to understand, do I have someone that I trust? Because if I'm believing their story and it ties together and it makes sense, and you've got the buyer groups, maybe they didn't go to the right buyer groups. Maybe they were, again, maybe they did a limited auction, maybe it should have been broader. And so there's a lot of reasons that as long as I can start to internalize, it makes sense, and then you start seeing the financials and it's checking out, and whether it's changed or not, you can start tying it together. I don't have a lot of discomfort in then going out and telling that story again and explaining. And if someone does come to me, like, well, either this is what I know or this is what I don't know. And like, again, continuing to be honest with, well, that was that situation. Here's what the business is today. I apologize it didn't work out for you last time. You know who we are. This is how we operate. You won't have that same problem. So, and again, the one thing that I'd say that, and I think I've developed it a lot from the buy side over the years, but like, I know what I need to accomplish in a conversation or in an interaction. I don't know how I'm always going to get there. And it's the same way with putting that out. Like, don't think that you can just flip a teaser out, an email, and an NDA. Like, pick up the phone, call the people, understand, tell them a little bit about it, see immediately what kind of reaction you get. Do you need to level set on what the current situation is or what's changed a little bit? Maybe giving a little grace to somebody that maybe had themselves, they got burned a little bit, and they had an NDA, so maybe you can share a little bit more information on what's changed, maybe some changes in management. I think there's some discretion there that we have as advisors to do that, and it's in our best interest at that point to at least start controlling the narrative again, because inevitably you've lost control of it, or you never had control, but now you are. And so you may have to do a little bit of more homework, a little more work on the front end. But that's always like, just start with like, do I believe the story to begin with? And if you don't, that's probably a good sign that it's probably going to break again.
Yeah, I agree with that. And well, one, you should go to the greeting card business. Your phrases are phenomenal. I mean, just record yourself. These are. I'm stealing some of these. No, like I think if we're the second bank as opposed to it's us remarketing a deal that's one of our own. Completely understanding that and understanding what happened is very key. I agree. And we had one instance last year that we presented it. We presented what we thought was a very actually aggressive valuation range for a company here in Illinois, and a larger shop had pitched this world in which this particular company would trade for 2-3 turns more than the upper bound of our range, which just didn't add up. We know we can't meet that. We were very honest with them. Of course, that group took them to market, never got them anywhere near what that was. So they level set that expectation for their client, and they weren't able to hit that mark. I'd love to work with that business. It was a great business, family-owned business. But if they, we've had some slight interaction with them. And if that does come back, I want us to be 100% on the same page, because we know exactly why it didn't sell the first time, is that they went out with an unbelievably unrealistic expectation of value, and that's where we want to make sure that would be the narrative we tell the market. It does not need to be anything more than that. We're not going to try to drive down the valuation of our client's business, but we're going to try to maximize it in a realistic range.
And I guess I would just add, as mostly a buyer, just looking for an honest conversation with the seller and the advisors on what's been fixed, what hasn't been fixed, what's the real deal here, because most buyers are sophisticated and they'll see through the bull.
Are there any go-to deal structures that you would like to see in these cases where you've had a failed process and you need to get over some roadblocks?
We try to limit structure as much as possible because it creates misalignments in a lot of ways, but sometimes it's unavoidable. So I think structure is most helpful where there's a gap in confidence, and the confidence can be one of two things. Either one, there's a potential issue of a downslide in the business, whether it's a customer or maybe there's something needs to be replaced, or there's a concentration or something, and we're a little concerned that the business is going to take a slide. Or the other is where the buyer says, hey, I've won all this new business, it just hasn't come online yet, it's going to be great. And the buyer just doesn't have that same information that the seller has. So, those are cases where you can put in, on the downside, you can do an earnout. Sometimes seller financing is certainly possible, junior maybe to the buyer's financing to protect against that downside. On the upside, earnout is kind of the classic way to do it. It's got to be structured properly, though, and it's more complicated than it sounds. Where they do it on a revenue or gross profit and EBITDA basis, because ultimately you're trying to make sure that everyone's got the right alignment of incentives going forward, and what you don't want is for the structure to create incentives for the short term that hurt the business in the long term. And then the second thing is you don't want to the incentive piece or the structure piece to create animosity or the various shareholders having a misincentive on how to run the business going forward. So, for instance, if I'm incentivized that the EBITDA needs to be a certain level in the next 12 months, I'm not going to be willing to hire the people that are going to benefit in the business in the long term. Or if you do, then there's going to be a fight as to whether we should do it or whether we shouldn't, because people have different incentives. That's the biggest issue with the structure. But sometimes it's a necessary evil to fill that gap in confidence.
Yeah, let me just add, as a seller, I hate earnouts, okay? As a buyer, I did them all the time, right? Here's the challenge, though, on earnouts. If you're the seller and you have an earnout and you don't control the dynamics that drive the metrics to get the earnout, you're screwed. right? So that's why buyers like them, because they can hold their toys back until the earnout happens. So you have to be very careful with that, right?
Okay, so in today's capital environment, where buyers' expectations are today, let's say there's a deal that fails. What are you telling that seller? What should that seller be doing in the first 30 days? If it fails today, what do the next 30 days look like?
I think it doesn't really change from the comment that we made earlier. You level set, figure out what happened, and get if it makes sense, get it back to the relevant buyer base ASAP. If not, say what, let's hit pause, and this is the reality of today's capital markets. So this could be a blessing in disguise with pending decreases in interest rates or whatever. Make the high street capitals of the world sweat more, because they've been waiting to deploy capital, and then we'll get them even more in 3 to 6 months. Love you, Brian.
Yeah, I mean, if it was a buyer issue and the performance of the business is great, then there's no reason to sweat. You're on offense, and there's plenty of money out there and plenty of buyers out there. So, but it's up to these guys to find the right fit, right? And you have a targeted approach. Who's going to get the deal done and why? Who has the highest closing probability? That's probably the largest criteria at that point. But if you got a good business, there's plenty of buyers.
Yeah, I'd say establish calm, cool, relaxed. We got this. This is where we're going to focus. This is the direction. And again, at times too, it's hey, let's relax. We'll come back tomorrow. Let us put our heads together, digest. I mean, unless you either have the answer, but kind of starting to make sure you give them the direction over the next 30 days, whatever it may be. And to your point, if it is just the buyer issue, we've talked to 30. We've got 10 we really like. Let's just refocus there, and you continue to run your business. You do what you need to do. We have a little bit more work on our side. We'll talk to you tomorrow. And the one thing I'd say in general too is just not shying away from the tough conversation. So I think that's a moment where you have the opportunity as an advisor to lean in, to have that tough conversation, to show your humanity. And, we're going to put this together. We may not have the exact answer to them today, but tomorrow we're going to come back. And really, I think those are the same thing with, having something bad, but you see the performance going forward, it's not a bad thing. We told you it was going to break down a few times. This is one of those times. We've got a plan. We have more work to do. You just keep doing what you do, so.
I would just add, it's just an honest assessment of where you are, but it sometimes helps the advisors find a better business fit for who the right person needs to be.
Yeah, we'll say that we say that the best businesses will trade in any market, right? Up or down, the businesses with a compelling business model will typically trade. Thank you, everyone, for attending. We're going to still be up here in case anyone has any more questions, but thank you so much for attending the panel.
We are so grateful to Eric, Heath, and our panel for sharing their candid stories and practical advice on navigating a second attempt at closing. Join us again next week for another insightful session from M&A Summer Conference.